Hey guys, hope you're doing well out there. About 3 weeks ago, I got a comment here on the channel asking me to cover three companies in the financial services space I previously haven't looked at, that being S&P Global Incorporated, Moody's, along with MSCI. And as I began to prep a video for all three of these companies, I realized there's enough substance for me to do a dedicated deep dive on just S&P Global itself. And so if you certainly like a video like this and want me to cover the other two companies, Moody's and MSCI as well, be sure to leave a comment down below and I'll be sure to cover those on a future video here on the channel. And along with that, I really appreciate that comment because it introduces me to companies I normally don't tend to look at and really opens my investing horizons beyond the companies we obviously tend to look at here on the channel. So I really appreciate you guys leaving those comments down below, asking me to cover stocks I normally don't tend to look at. Now, with that being out of the way, let's take a look at S&P Global Incorporated. This video will be slightly different. I'll talk more about the business of S&P Global, what they do, and really what makes this business tick, along with their different range of products and services. As always, though, we'll take a look into a little bit of the news surrounding this company. We'll take a look a little bit into their financials, and then as always, we'll jump into the technical chart patterns as well. If you guys are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. So S&P Global Incorporated is a $155 billion financial services giant. And as we get along into the video, you'll see this company is operating in the financial services industry. But if I had to classify it, I would classify it as a data and technology company because at its heart, at its core, I think that is what this company does best. And we'll talk more about that in the business model. You also get a small dividend yield with this of 0.73%. We'll talk a little bit more about the dividends as well. And then the valuation, you're looking at a company that is profitable and trades just a little bit over 30 times a forward earnings multiple. Now, from the qualities that this company possesses, it actually may not be an overly egregious valuation to put on this company. So we'll talk a little bit more about the valuation as well. In terms of the performance, this company year to date is up 14%. Now, that would be pretty solid on an average year, but well, 2024 wasn't really an average year in the markets as the S&P 500 went up nearly 27%. And you saw a little bit of underperformance. In fact, even over the last 3 years, this company has underperformed its own index that it created, the S&P 500, by a pretty wide margin. And then over the last 5 years, you're basically keeping up with the S&P 500 benchmark as well. It's when you stretch it out over 10 years, that's where this company really has outperformed its own created benchmark of the S&P 500. And like a lot of the names we cover here on the channel, this is one for those patient investors that like to hold dividend growth companies, along with companies that they want to see capital appreciation over the long term. This is probably not one of those companies you're looking to swing trade or trade in and out of because you begin to see a massive amount of outperformance the longer you hold a company like this. And so the question really is can S&P Global get back to the point of outperforming the benchmark that it once created? And can it begin to once again outperform the other companies in this space? Now, the other thing you'll see in this video is because this is a company I haven't really looked into in the past, you'll get an insight into what I do when I want to research a company that I'm not very familiar with. And the first thing I do is come here to Seeking Alpha, and they provide this company profile sort of summary near the bottom of the page where they give you a little bit of a description into what this company does, what their products are, and what their different business models are as well. They tells you about when the company was founded, how many employees it has, and so on and so forth. So S&P Global is a company that's really old, founded in 1860. They have around 40,000 employees. It is based out of New York in the States, and then it obviously operates in the financials industry sector. And so along with its subsidiaries, it provides a credit rating, benchmark, and analytics workflow solutions in the global capital, commodity, and auto market. So what that really tells me is they do a few things. They provide credit ratings. I think when we get into their business, that's one of the largest parts of their business. They also provide benchmarks, which, as we know, the S&P Global name is really derived from S&P 500. And so they're creating those benchmarks and indices. And then the other thing that's really core to them is they provide analytic and workflow solutions. So things like data and analytics to different companies. And really the field that they operate in are threefold. The first being global capital. So think banks, maybe think corporations, maybe think government, anyone that really needs to take out capital to do anything. Yeah, you'll probably be going through S&P Global at one point or another. They also have a big role in the commodities market as they collect a ton of data on different commodities and different industries as it pertains to commodities. So think maybe agriculture or energy as well. And then lastly, the auto industry is another thing that S&P Global collects just a ton of data, and how they package and sell that data is really what makes this company so valuable. And so they have 5 core business units that we'll do a deep dive in, but as a brief summary on each one, the first one being market intelligence. This is the largest part of their business. Nearly more than 30% of their revenue comes from market intelligence. That segment offers multi-asset class data and analytics included with purpose-built workflow solutions. And so that really talks to this part of their business where they're considering the analytics and workflow solutions, particularly as it pertains to the global capital markets. The second part of this business that is, again, really large, nearly 30% of their overall revenues, comes from the rating segment that operates as an independent provider of credit ratings, research, and analytics. So credit ratings is a very, very big business. Basically, if anyone ever needs to take out credit, they need to have that credit rated, at least from a corporation or a government perspective. And yeah, there's only a handful of companies that do those credit ratings. S&P Global is one of the largest, if not the largest, that does that. And so that is the second largest segment of their business. Very, very important. We'll dive more into the ratings part itself. You also have a commodities insight segment that provides information and benchmark prices for the commodity and energy markets. So think oil, think metals, think agriculture, anything related to commodities, and any of the data that's likely being provided or any of the analytics that are being done on that data is likely coming through S&P Global Commodity Insights. Next up, you have the mobility segment, which provides solutions serving the full automotive value chain, including vehicle OEMs. You have auto suppliers, mobility service providers, so think Uber and Lyft. You also have auto retailers, consumers, and insurance companies as well. So throughout the entire automotive value chain, there's a lot of data that needs to be managed. There's a lot of insights that can be drawn from that data, and S&P Global Mobility segment works on collecting and packaging that data. And then last but not least, the part that you're probably most familiar with, at least based on the name, is the S&P Dow Jones Indices segment. So that segment is an index provider that maintains various valuation and index benchmarks. So of course, think of the S&P 500, think of the Dow Jones Industrial Average, along with pretty much any other index, any other ETF out there tracks, likely was created by the S&P Dow Jones Index segment. So they basically just create all these indexes that then license out those indices as benchmarks to ETFs that are being created every day. And this is basically a play on passive investing. So as long as ETFs and indices continue to remain the gold standard in investments, yeah, I think S&P and the Dow Jones Indices segment will continue to do great. So that's a brief insight on their 5 business segments. They have the market intelligence, the ratings, the commodity insights, mobility, along with the indices segment. So that really is what makes S&P Global a company as a whole. And again, this little blurb on Seeking Alpha's page is a great place to start to know about the company profile, really a summary on what it is that they do. Now, before we get a bit more deeper into their business, wanted to talk about how consistent of a dividend company this is. So they've now paid out dividends for 51 consecutive years, making them a dividend king. You also have 51 years of consecutive dividend growth. So not only are you getting those dividend payments, you're also getting dividend growth along the way. In fact, back in 2017, they had a nearly 41 cents dividend per quarter. Now that's up to nearly 91 cents. You've more than doubled your dividend over the past 7 years. So the growth of the dividend is, I'd say, in the mid to low teens. And that's pretty solid for a company that's been growing it so consistently for over 50 years. So keep that in mind. This is a dividend king. You're expecting those consistent dividend payments in the future as well. The other thing to note about this company, at least at the current time, is they're going through a C-suite shakeup. So they're replacing their existing CEO with the current president, the previous president of S&P Global Ratings. So like we just said, ratings is a very, very important part of this business. The previous president will succeed to be the CEO effective November 1st. So she's in fact been in the CEO position for roughly 2 months. She's succeeding Douglas Peterson, who will still remain on the board until the end of 2025 as a special advisor. Now, the reason why this CEO switch isn't as concerning is because, first of all, it's an internal hire. They're basically taking the previous president of one of their largest business segments to now replace the CEO. The other thing is that the previous CEO will continue to remain on the board until the end of next year. You're also not having any change in full year financial guidance. So this just seems like an internal handoff, simply probably because the previous CEO is retiring. You also now have a change in the CFO along with the change in the CEO. So a bit of a C-suite shakeup over at S&P Global. I think that's something that's overly concerning, just something to keep in mind. Now, with S&P Global, we talked about their 5 core business segments. It's important to look at how they're performing, and along with that, the margins on those business as well. So this is directly from their Q3 report. They have this slide deck where they break down each of those 5 business segments. They break down the revenue growth in the most recent quarter, along with the adjusted operating margins and the operating margin growth. And first thing I want to point out is you're seeing revenue growth along the board for this company. The global market intelligence, which is the bread and butter, the largest part of this business, is growing a bit slower at just 6%. You have the ratings business growing revenues at 36%, commodities insight growing 9%, mobility as well growing 9%, and then you have the indices business growing at nearly 18%. So in the most recent quarter, the overall company grew revenues by nearly 16% year over year. That's pretty strong growth, especially from one of their largest segments, ratings, up nearly 36%, as more and more corporations begin to take out debt, as interest rates begin to be lowered. The ratings part of their business will do phenomenal, simply because more companies are willing to take out credit, and well, they need to have that credit rated in order to get pretty solid interest rates. And there's only a handful of companies out there that are willing to rate that credit. The other part of their business that is growing pretty fast is the indices segment, which again makes up a smaller portion, right around 10 to 12% of their overall revenues, but it's growing fast. And what's important is it has phenomenal operating margins at 70%. That's right, 70% operating margins. That's not gross margins, that's 70% operating margins. And a lot of that is because it's a very simple fee system business where they're just collecting fees on licensing out those indices. So anytime anyone wants to benchmark against the S&P 500, they probably pay S&P Global a small fee to do that, whether it's creating an ETF or creating a custom index itself that matches the S&P 500. Similarly, they have thousands, hundreds of thousands of other indices. And so anytime anyone wants to use any of that data or any of those indices, they pay a small licensing fee to S&P Global. And well, yeah, that's going to be ultra high margin at nearly 70% operating margin. So anytime you have a business growing at 18%, that's also a 70% operating margin business that's expanding operating margins as well year over year. That is an exciting business segment to take a look at. You also have growth in the other parts of their business along the board. As you see, the market intelligence operating margins at nearly 33%. That was up year over year. Ratings business as well, coming up to nearly 62% operating margins, up 6.5% year over year. You also have a 47% commodities insight operating margin segment, and then you have a nearly 40% operating margin mobility segment as well. So along the board, this company has absolutely terrific operating margins, nearly 48.5% overall operating margins for the company that is, again, raising year over year 330 basis points. So not only are you seeing revenue growth, you're seeing that translate into operating margin expansion as well, probably pretty solid net income expansion as well. So that tells you a little bit into the strength of each of their business segments, tells you that all of their business segments really tend to work together. A lot of the data they collect through the market intelligence, they can then package and sell in their ratings business or their commodity insights business, even the mobility segment as well. So these business segments tend to help each other. They're also growing relatively lockstep and have all terrific, phenomenal operating margins as well. So let's do a bit of a deep dive into the market intelligence segment itself. So really, what is the market intelligence segment? So they have a number of products and solutions there. The core product is, I believe, the S&P Capital IQ Pro product, which is really a desktop terminal similar to Bloomberg Terminal. In fact, I think this is their competitor to the Bloomberg Terminal. So if anyone really wants to get information or data or analytics or insights into what's going on in the capital markets, that can be done through a product like this. They also have another product called Ratings Direct, which is, I believe, how they gather intelligence and insights into different credit ratings products, and then they go ahead and sell that in the ratings segment of their business. Along with that, they have bond pricing indicators, they have risk indicators to gauge the risk in capital markets, along with specific industry such as supply chain and power applications. They also then do credit analytics and credit and risk analytics to, again, gather a whole bunch of data and insights as it pertains specifically to credit. And really, as long as you think credit will continue to grow as a main source of financing in the global economy, yeah, this part of their business will continue to do relatively, in fact, really well, because the data that can be unlocked from various types of credit will continue to just increase. Along with that, this sort of market intelligence isn't limited to one industry on its own. It applies to corporations, whether they're in the energy, mining, real estate, maritime, technology, whatever industry they're in, they certainly can utilize this sort of data. This can also apply to different financial institutions like banks and venture capitals and private equity that tend to loan out credit or at least work heavily in the capital markets that will vastly benefit from a lot of data and insights they can grab on that. And that, again, also applies to governments that need to gain access to various data to see how it impacts economies, whether it's from corporate credit or supply chain. So a lot of that data is collected using market intelligence. In fact, I was curious to see where Seeking Alpha itself gets its market data from. And lo and behold, I found that the fundamentals, estimates, and Wall Street analysts on Seeking Alpha are provided by S&P Market Intelligence. And then some sector and industry data is provided by the Global Industry Classification Standard, which is created by none other than MSCI, along with S&P Global Market Intelligence. So if you've ever used a site like Seeking Alpha or Yahoo Finance or really any other site where you look to get info or data on capital markets, that's probably coming from S&P Global Market Intelligence. That's really what they do really well. And that's one part of their business that, again, is growing rapidly, has high margins, and still makes up the vast majority of their revenues. The next part of their business we'll take a look at is the rating segment. This, like we saw, is very, very high margin and is growing very fast, nearly 36% revenue growth year on year. So ratings, as it pertains to the credit industry, is really, really important. Basically, anytime a government or a corporation needs to take out credit, they need to have that credit rated by an independent provider such as S&P Global, because the bank or the institution that's actually lending that credit needs to know what is the credit worthiness of the entity or the government or the company they're actually extending that credit to. And so the way that's done is using a rating scale, and the one created by S&P Global is a rating scale that goes from AAA down to A, all the way down to D. So if a, let's say, company wants to take out credit and that credit is rated at a AAA investment grade, well, then that's fantastic. They'll get a very nice interest rate on that credit because that company is deemed to be very highly credit worthy. They're in a strong position to meet those financial commitments, and they're likely not going to default or cause any issues in paying back that credit. But let's say you have a company that wants to take out credit that's rated at a C or a triple C or even a D rating, well, then that company is likely to default on that payment or on that financial commitment, and also maybe breach that promise simply because they're not in a great financial position. So anytime a company wants to take out credit, they have to get that credit rated. And anytime you get that credit rated from a trustworthy company like S&P Global, then you automatically have a slight advantage in receiving that credit because, again, your credit was rated by an extremely trustworthy company. And so that's really the basics of how the rating system works as it pertains to the credit industry. And along with that, the credit rating industry is really dominated by three big agencies which control nearly 95% of the ratings businesses. And those top three firms include Moody's Investor Services, S&P Global, along with Fitch Group. And so you have Moody's and S&P located in the US, and they dominate nearly 80% of the international market. You have Fitch as the third player, which controls nearly 15% of the global market. So combined, that's nearly 95% of all credit ratings that's done out there controlled by these three companies. And S&P Global itself is doing nearly 40% of all global ratings. So they have a very, very big market share. They have a huge moat in this industry. It's pretty much an oligopoly where just a handful of companies control all of the ratings that are done out there. And anytime you get your credit rated by one of those big three companies, you'll naturally get a slightly better interest rate simply because these companies are considered really good at what they do. they're also considered really, really trustworthy as well. So keep that in mind. The credit rating business is really only a handful of companies that controls it. It's a very profitable business, like we saw from its margins of nearly 62%. Again, also growing very nicely. Now, keep in mind, anytime you see a slowdown in this business, it's likely when credit will be going through a pullback. So like we saw at the end of 2022, when corporations were hesitant to take out more debt or more credit, when interest rates really skyrocketed, you'll see a decline or a slowdown in this part of their business because, again, it relies so heavily on corporations and governments wanting to take out more and more credit. So keep in mind, this part of their business is slightly cyclical, and anytime you see an economic downturn, you'll probably see the ratings business do poorly. Next up, we have the commodities insight business, which is very similar to the market intelligence business, if I describe it, but instead of focusing on the capital markets, it simply focuses on the commodity market. So they provide a bunch of solutions for agriculture and food, for biofuels, for chemicals, for gas and power, for oil, for LNG, for metals, and so on and so forth. So anytime you come across data or analytics for any commodity out there, likely it's probably coming from S&P Global's commodity insights. And then what they do with that data is they package it in the form of market insights for commodities. They package it in softwares. They can highlight the risk that certain commodities may have in certain times, and so on and so forth. So that's really the importance of the commodity segment of their business, very similar to the market's intelligence, but instead of focusing on capital, they focus on the commodities market itself. Next up, we have the mobility segment of their business, which again, very similar to the commodities and market intelligence. They gather a whole bunch of data and insights on a specific industry, this time being the auto industry. So as it pertains to the auto industry, they are actually the owner of Carfax. So if you've ever gone out and tried to get a report on a used car, you've probably used Carfax. Along with that, their solutions are used by nearly every major auto OEM out there. 90% of the top 100 tier suppliers, media agencies, government, insurance companies, financial stakeholders, and then they provide the actionable insights and enable better decision making from their data. So again, a similar business model where they collect a lot of data, they try to package it and distribute it to an industry that's very data reliant, this time being the auto industry. And then last but not least, you have the indices part of their business, the S&P and Dow Jones indices, which really serve in creating benchmarks across the capital markets as well. So anytime you see an index out there like the S&P 500, like the Dow Jones Industrial Average, chances are that index was created by S&P Global that they then license out in terms of index licensing for other companies and banks out there to create ETFs and other structured products. So anytime an ETF out there is mimicking an index, it's likely paying a fee to S&P Global to do that for themselves. Now, you also have data and benchmarking, where again, you collect a lot of data on those indexes that you then sell to people that need to create funds or model portfolios or analyze market trends in order to do that. And then lastly, you also can create custom indices, again, mimicking existing indices or creating ETFs that match those indices as well. So anytime you do anything related to tracking an index or creating an ETF that then mimics an index as well, likely S&P Global's indices business is getting a licensing fee on that side. So again, a very, very important thing. The other part of this business that's really crucial is the fact that it's super broad based. So you're not just in equities that's in the US, but you're also in emerging markets, in global equities. You have ETFs that track fixed income or money markets. You also have commodities indices. Along with that, you have specific dividend indices, whether it's high dividend yields or thematic indices like healthcare and innovative technologies. So this part of their business really ties into all aspects of the markets, whether it's equities, capital, commodities, or real estate. Really any part of the capital markets that can be created as an index and then be benchmarked against, that is what this part of the business does. And again, that's why they see nearly 70% operating margins on that side of the business, because it's essentially just licensing fees that this company collects to provide those indexes. So that really tells you the different business segments over at S&P Global. You obviously have the market intelligence, which still makes up the vast majority. But if there's one theme across all of these business, is they've figured out a recipe that works and they've just applied it to different parts of the market. So market intelligence is just collecting data on capital markets. The ratings business is, again, being one of those dominant companies out there that can be very trustworthy in rating credit. the commodities insight is again collecting data, but instead of capital markets, focusing on commodities. Mobility is again collecting that data, packaging it, and selling it for the entire automotive value chain. And then the indices business is licensing out hundreds of thousands of indices to be benchmarked against and for ETFs to be tracked against. So all of those things give this company a very, very powerful moat, gives it a very strong position in what they do. They're very, very hard to be disrupted against, and it provides them with phenomenal growth and even better operating margins. Now, outside of their core business, it's important to take a look at how this company performs according to what expectations are. So from their latest Q3, which came out at the end of October, they came in with a revenue beat. Again, that's 16% revenue growth. They also came in with a strong bottom line beat, as well as raising their full year 2024 guidance. Previously, the estimate was for nearly 10% growth on the top line. They raised that to nearly 12% growth at the midpoint. They also raised adjusted diluted EPS for the full year to now be at $15.10 up to $15.30, higher than the prior consensus estimate. So this company comes in with beats. They also came in with a raise depending on how good those results came in. And along with lifting their guidance, they're also accelerating their buyback. So this is the other thing this company does really, really well. They're a super shareholder friendly company, as they have a nearly $1.3 billion buyback coming near the end of this year in the coming weeks. And they've already repurchased nearly $2 billion worth of their common stock throughout 2024. So as we take a look at the financials, you're not just looking at a company that is a pretty strong business model and a pretty strong moat. You're also looking at a very financially sound and investor-friendly company. Now, with all that being said, there's a lot to like with S&P Global so far. One thing to maybe not like as much is the balance sheet. So we come down to the balance sheet, we see they have nearly $1.7 billion in cash, another $3.5 in current assets. And so you have total current assets coming out to $5.2 billion. Again, 9 months ago, you were at $5.1 billion. But you do have a fair amount of long-term debt this business now holds at nearly $11.4 billion of long-term debt. They really have no short-term debt. So you're really just taking a look at this 11.4, comparing it against the 5.2 billion in current assets you have. So one thing to keep in mind, a lot of this long-term debt was taken on to complete an acquisition of IHS Markit, which is again a leader in data and market intelligence as it pertains to the capital market. So that acquisition recently closed, I believe, at the end of 2022, and this company has slowly been trying to pay down that debt over the next couple of years. I believe they'll continue to do so, but at the current time, they do have a fair amount of debt that they'll likely pay some interest on moving forward. The other thing they did with that acquisition was raise a fair amount of money from equity, and so they did dilute a lot of shares outstanding in order to complete that acquisition. So that's the other thing you're getting with this company, is generally you tend to get a pretty solid buyback. You did experience some dilution because of that acquisition, but again, that acquisition is supposed to bolster on to their market intelligence business. And as they realize the cost synergies and efficiencies from that, I'm sure they'll continue to pay off that debt and continue to buy back their stock, reducing shares outstanding. In fact, from the cash flows, you see over the last 9 months, nearly $4 billion in operating cash flows, and they return nearly all of it to the shareholder in the form of a $2 billion buyback, nearly $850 million in dividends, and then you completed small tuck-in acquisitions of close to $200 million, and the remaining $400 million gets bolstered on to their cash pile. So a very, very cash-friendly and shareholder-friendly company, as they try to return pretty much all of their operating cash flows back to the shareholder. They're very capex light, and so this is an asset light business that really focuses on data and technology. They're also rolling in Gen AI features, not just onto their products, but also internally to boost productivity as well. So I think there's a lot to like about this company. I think from its fundamentals, it looks pretty sound. The balance sheet does have room for improvement, certainly, and I believe they'll continue to do that as they continue to spit out cash flows. And then from its business model, it's just a very, very dominant company that's growing across the board, that's seeing margin expansion, has a very, very wide moat and dominant market share position in really everything they do. The one reason to possibly now be concerned with the stock moving forward, I believe, could be the valuation. So now as we take a look at the valuation, this is where I have my concerns with this company. You're going from a growth rate on the revenue side from 12% down to maybe 6.5% in fiscal 2025. And then on the earnings side, you're nearly slowing down in half on your earnings growth potential from 22% earnings growth now down to 10% expected earnings growth in the upcoming year. Certainly, you have the opportunity to surprise to the upside if this company can grow maybe 13%, 14%, even in the mid-teens on the earnings side. That could be a pleasant surprise. But again, you're seeing that nearly high single-digit, low double-digit earnings growth, and you're still putting on close to a 30 times earnings multiple on this company. So my fear with this company is as the growth rates begin to slow down, will you see that multiple compression begin to take place? This company for the longest time continues to trade higher than the average S&P 500 stock, and I think for the right reasons. But as you see the growth rates begin to slow down, both from a revenue and earnings perspective, will you see that that multiple compression begin to take place? And so I think just from a valuation perspective, on the surface, it seems pretty fairly valued, at least at the current time. You're looking at nearly a 30 times forward earnings multiple for growth rates in the low to mid-teens. I think what still allows this company to command a pretty high multiple in the 30s is simply due to the fact that they have expanding operating margins, they have still pretty decent revenue growth, and they have a very, very high degree of predictability and a very wide moat as well. So things like that, I think, do certainly contribute to having a higher earnings multiple simply because how strong and defensive your business really is overall. Now, last but not least, let's take a look at the technicals as it pertains to S&P Global. One thing I want to point out is if we stretch this out to an all-time chart, this company likes to go on massive monster uptrends. And we've seen that a number of times in this company's past. In fact, from the 1975s to the 1990s, you saw a nearly 15-year uptrend that was intact, and then that broke through. But once it broke through, you found some footing at the end of the 1990s, and then you had another monster uptrend for the next 18 years until 2008. You then once again broke through that uptrend. At the end of 2008, you started another monster uptrend that lasted nearly 14 years to the end of 2022. And now we're once again in the uptrend that began at the end of 2022. So are we perhaps in another decade-long, multi-year-long uptrend with S&P Global? That certainly could be the case because you're making a very, very well-defined pattern of higher highs and higher lows as well. So from a technical perspective, you could absolutely certainly make the case that, yeah, this is another multi-year, maybe even a decade-long uptrend. And anytime it comes near the bottom end of this channel, near $500, you make the case, you step in and you buy shares. It could be as simple as that. And really, anytime it comes up near the top end of this range, maybe you don't sell your position, but perhaps you just stop averaging in and stop buying more shares near the top end of the range. That could be a very, very simple way to play this company. Certainly, if you have the long-term perspective, long-term mindset that you believe this company will continue to dominate what they do, then yeah, absolutely. Anytime it touches the bottom end of the range, you step in and you buy, simply because it's proven to be the successful way to invest in this company over many, many decades. At this $500 level, from a psychological and technical perspective, certainly looks to make sense. I think the valuation could be considered pretty fairly valued at the current time, close to 30 times a forward earnings multiple. You're also seeing that growth rate slow down. So this is a company I would certainly have on my watch list. It's one of those companies that can absolutely be a staple in your portfolio, decrease the volatility of it, and continue to maybe get those dividends, reinvest those dividends, and begin to see outperformance over long periods of time. And so that's really the way I would play S&P Global, is you buy them on the dips. Anytime it comes down to the lower end of the channel, maybe pick up a few shares, maybe pick up fractional shares, and then as it heads higher, ease off on purchasing, and you pretty much just rinse and repeat. For now, I will keep this one on my watch list simply because the valuation I think looks pretty full. I would wait for maybe a deeper pullback, an opportunity to step into this company that maybe at times seems to get undervalued, but doesn't stay there for all too long. That was my take on shares of S&P Global Incorporated. Let me know your thoughts on this company in the comment section below. Also, let me know your thoughts on a video like this where we cover more of the business and what they do and what makes them so successful. Along with that, if you want to see a deep dive into Moody's and SMCI, let me know in the comment section below. I'll be sure to cover those in future videos here on the channel. As always, happy holidays, happy new year, and good luck with your investments in 2025. I'll catch you guys in the next video.